Hello, fellow rebel capitalists. Hope you're well. I wanted to do a quick dive into buy the dip and looking at it through the lens of government deficit spending declining. You guys heard the news today that Build Back Better Act is DOA, dead on arrival. It most likely is not going to pass. Therefore, we're going to see government deficit spending declining into 2022. What does this mean for the stock market? And then zooming out, what does it mean for the stock market as far as this strategy moving into the next 2, 3, 4, 5, 10 years if the government doesn't come back in and start spending like they did in 2020? Now, I think they will eventually, but we're just trying to use this as a thought experiment so we can start answering economic questions by first and foremost answering and understanding political questions. Okay, so let's get into the first chart. Let me do a screen share. This is, oh, no, that's not the first one. Here's the first one. This is the S&P 500 adjusted for inflation going back to roughly, what do we got here? 2000, January 2000. We were at, call it 2,400. And then we went through the dot-com bust and went down to roughly 1,200. So we were down about 50%, 50. Now let's look at what happened during the GFC. We started right around 2000. We end up even below 1,000. So down more than 50% again. But what's interesting is let's look at the time it took the stock market to recover. You see, today we just assume that, well, all I have to do is buy the dip. Buy the dip. I mean, just that's the strategy. And I find myself, and I've studied this stuff, I know better. But even to this day, I find myself kind of just basically falling asleep, for lack of a better word, and just kind of daydreaming a little bit and saying, yeah, well, that actually makes sense. Maybe you should just buy the dip. And then I've got to like, oh, whoa, wake up, George, wake up, wake up. Look at a chart of history. That's a horrible strategy. But it just, everyone falls victim to that recency bias occasionally. So it's important that we look at historical charts to understand that it's not just about buying the dip. Now, I'm not saying that you don't buy things when they're cheap and sell them when they're expensive. I know I get a lot of comments on my channel saying, oh, George, well, if I would have taken your strategy, I would have missed out on all these gains since 2020. And first of all, that person has not watched my videos at all. And it just, when people make a comment like that, it just shows their level of ignorance. So if that's you, I would refrain from doing that in the future because you just make yourself look incredibly foolish. But if you want to comment like that, go nuts. For most of you that actually do watch my videos prior to commenting, you know that in March of 2020, I was out there. I wasn't telling people to buy because that's not what I do. I don't tell people to buy and sell and give stock tips and all that stuff. But what I was doing is buying myself. And I was saying, hey, guys, things are getting cheap. It's interesting how cheap they're getting. In fact, I don't know if I was the first person that I'm sure someone had to talk about it before me, but I did a whiteboard on Carnival Cruise Lines. This had to be back in, I don't know. I mean, you can fact check me or whatever. Probably February of 2020, maybe March of 2020, where I was saying, okay, this market's crashing, but there are some things that are getting cheap now. And as most of you know, I bought a lot of commodity producers back in March of 2020. I bought oil producers, I bought coal producers, uranium, I bought gold miners, and several other stocks. So this this argument that you would have lost out on all these gains if I would have done what George did, that's completely nonsense. But I wasn't buying the dip, so to speak. That wasn't my idea. Oh, I just got to buy the dip because the stock market always goes up. No, no, no. I was buying things when they are cheap based on their inflation adjusted price. That is much, much different. So let's go through this again. And I want to I've shown you the dips in the market and how much the S&P 500 went down. But look at the time that it took to actually recover. So if you would have bought the market, let's say you're just dollar cost averaging, like they always say to do, or you're retiring and then you're listening to, gurus out there on YouTube that just tell you to buy, 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 buy. I don't know, someone that also thinks that we should have the military force people to inject a foreign substance into their body. Unfortunately, that person actually came down with the well, I don't want to throw anybody under the bus, but that person, for better or for worse, came down with the cerveza sickness, even though he had the medicine 3 times. In fact, that goes well, Josh, because he didn't just buy the medicine. He buy the medicine. there you go. But anyway, okay, let's get back on topic here, George. But if you would have bought the S&P 500 in March of 2020, because, hey, that's the right thing to do. That's the prudent thing to do. It's like Dave Ramsey tells me all the time. You just got to take and just get out of debt and buy stocks, 401k, at any price. It doesn't matter. Don't you know? Stocks in the United States, they always go up. Okay. Well, how long would it have taken you? And again, I'm not saying don't buy things when they're cheap. I'm saying this is the person that buys the broad S&P just because that's what Dave Ramsey tells me to do. That's a lot different than individual stock pickers who find opportunities in the market. But if you would have bought the broad S&P, it would have taken you to get back up to 2,400, 14 years. So just imagine if you're that 70-year-old person trying to retire and you've got your life savings in your 401k. You're 84 years old before you get to a break even. So you see, buying the dip isn't really, that's not the strategy. You got to buy things when they're cheap. Because buying the dip, that's fool's gold, really. Buying the dip, that's not a strategy. That's just something where you've gotten lucky because since, call it 2009, that strategy has actually worked. Or if you look at very long-term charts, that strategy works for periods of time. But let's look at the Japanese stock market for a moment. Actually, before we get there, I want to look at deficit spending because let's go back to my original point here. It would have taken you 14 years to get back up to that point if you would have bought in 2000. And if you would have bought here in September 07, it would have taken you. So we go from 14 years to now the time compresses to, call it, 4 years. From 2007 to 2013. And then the time frame goes from 14 years to 4 years to, call it, 4 months. But why? What changed? Well, as you guys know, they started quantitative easing right around here. So that definitely had an impact, more so a psychological impact. But let's look at the government deficit spending as a response to these recessions. So in response to the recession in 2000, the government ran a surplus. Now, I don't know, this might have been the year after. No, I think it was 2000 as well. But the bottom line is we didn't have really any deficit spending as a response to the dot-com bust and the recession that followed. Okay. And remember, it took 14 years for the stock market to quote unquote recover from that high water mark. Well, then we look at the high water mark that we had in 2000. What was the government's response there in the GFC? Well, now the deficit spending really goes up 1.5 trillion 2009, and it stayed very high for the next, call it 3 or 4 years. But then what happened to the recovery of the stock market from that high water mark? Remember, we went from 14 years to 4 years. Now we've got the cerveza sickness, and look at the level of deficit spending, even compared to what we did in 2008. I mean, it's more than double. And this is as measured by Data Lab. And I would argue the deficit spending was much higher than that. Just look at how much the government debt went up in nominal terms. The government debt went up far greater than $3 trillion. So my guess is they're not counting everything here, but we'll just look at this chart as is, using it as a proxy. And so government deficit spending went absolutely parabolic, especially when you consider we did almost zero deficit spending during the dot-com bust. So then we shortened that stock market decline to 4 months. So what's my point? My point is that the stock market and the economy is far more dependent on government deficit spending right now. Or maybe it always has been dependent on government deficit spending and a combination of quantitative easing, but now they're actually implementing the strategy. And this is most likely why we're seeing such massive increases in consumer prices. There's no free lunch. You've got to steal if you're going to give the purchasing power to asset holders, you've got to steal it from non-asset holders. There is no solution, remember. There are only trade-offs. So my point is, now let's think through what's happening with Build Back Better. It's getting the kibosh, done sauce. So if we go into a world where the government deficit spending starts to decline and decline significantly, I mean, if this doesn't have, 2021, still very similar. But in 2022, listen, if they can't get this Build Back Better thing passed, and who knows what they continue to do, but you're looking at the deficits probably going back down to what they were in 2019, right around $1 trillion. So you say, well, George, that's still incredibly high. Right, but look at the rate of decline. I mean, that is an incredible decrease in the amount of overall government deficit spending. So my point is, if you're someone who's out there buying the dip, you are absolutely playing with fire right now. That isn't to say that if the stock market goes down by 20, maybe even 15%, that the government won't reverse course and start to make up an excuse to deficit spend even more. And that's the pushback. Oh, George, this is just fear mongering because we've got the Fed put now, or we have the government put. But not so fast. What was the CPI doing? And I went over this in my whiteboard video the other day. During the time, let's say between, well, it goes back even further, but let's just take what CPI was doing from 2000 to 2020. Remember, guys, CPI was going down as measured by the government. Consumer price inflation going down. So they're doing all of this increased deficit spending going into the GFC and quantitative easing into an environment where consumer prices were still going up, but they are going up at a lesser degree over time. So how does it work if now the government is in a position where consumer prices are not going down or going up at a lesser degree, they're going up at a much faster rate. They're going parabolic. So I'm not sitting here saying that the government won't come in and try to create price controls or try to just well, I was going to say rebalance. That's not even the right word. If the government and the Fed come in and completely change the way the CPI is measured in order to reduce the level of headline CPI even further, although prices are going up, it's just the way they measure it changes. Therefore, they get even more dishonest about the CPI. Therefore, people believe, or the market believes, that prices aren't going up to the degree to which they actually are. I think that could be definitely a possibility. But we have to understand that inflation, even if they're lying about the CPI, which they've done for years, but even if they lie to a greater extent, people don't care about that headline number if they see their grocery bill going up, if they see gas prices going up, or if they see rents going up. It doesn't. They're not going to see their all of these prices of the stuff they buy go up consistently. And as long as the Fed is saying inflation is going down or we're seeing disinflation, that they're like, oh, well, in that case, well, who cares about my grocery bill going up? I don't think that's the way the average Joe and Jane thinks. They look at the headline CPI and say, I don't care about that. I'm paying double for my groceries than I did 6 months ago. And it's very difficult to get reelected if we're going through significant periods of inflation. I mean, the 1970s is a good example of that. So the politicians that want to get reelected, they know that they can't just come in and save the stock market like they did through this government deficit spending in 2008 and in 2020. So I'm saying there's a possibility that we go into an environment where this deficit spending is continuing to go down. And if that's the case, you got to ask yourself, what does that do to the stock market? And what does that do to the probability of this buy the dip strategy, if you want to use that word, actually panning out over the next 5, 10, 15 years? Another chart I want to highlight is the Japanese stock market. Interesting that it peaked out at 38,000. I think the Dow got very close to 38,000 over the past year or so. Maybe not, 35, 36, something like that. But it peaked out in pretty much January 1st of 1990. And that was 31 years ago. And the stock market has still yet to recover. So what if you would have bought the dip in Japan? So you would have bought right here, you'd have bought right there. You said, oh my gosh, the Japanese, they're going to do all this quantitative easing, and that's going to really raise the market. So you buy there, buy here, buy here, buy here. Yeah, I mean, you're completely wiped out. So if you're sitting back and saying, oh, well, that's Japan, that could never happen in the United States. Really? Well, let's look at another chart from my good friend Chris Cole at Artemis Capital. And I'm going to have to change my screen share quickly, Josh. So bear with me one moment. So we're going to share my desktop. Entire screen. There we go. Okay, let's go to this paper, and you guys should all know this one. This is the allegory of the hawk and serpent. And what Chris did is he went back in time and he tested the buy the dip strategy, or what he calls buy the decline in equities. And you can see it as this kind of maroon line. And it starts off in late 1920s. And going into 1938, you're doing pretty well. So what this indicates is if you start with $1 What is the value of your portfolio after X amount of years? So if you started with $1 and used this buy the dip strategy, in 1938 or so, you would have had, let's say, $5. Great return. But then what happened? Over the next, we'll call it from 1940 to make the math easy, to 1982. So 42 years. If you would have, quote unquote, bought the dip, your $5 would have gone down to, we'll be charitable and say 10 cents. Not even 10 cents. Actually, a penny. So you see what I'm saying? Is if you actually look at the history of the US stock market, and for most people, looking back at the history of the stock market just means going back to 1981, where we've been in a down cycle in interest rates for 40 years. And you think that's studying history. Oh, well, look at this. You're buy the dip and you're doing great. And as if the stock market started in 1981, like we didn't have one in the 1970s or the 1950s or 1940s or 1930s. Like the stock market didn't exist back then. So this was the American stock market. This was not Japan. This was not something in Europe. This was not Weimar Germany, or this wasn't Colombia. This was the United States stock market. Bought the dip, start with $5, and at the end of 40 years, you've got, and it's hard to believe that's accurate, but I'm going to go with Chris Cole. That guy is one of the smartest people I've ever met in my life. So you've got about a penny if you start with $5. Bottom line is you go bust. So I'm not saying that the stock market is going to crash. I'm not saying that it's imminent. I'm saying it's most likely inevitable, but that could be 3 years, 5 years, 10 years, and it could crash in real terms. It doesn't necessarily have to crash in nominal terms. But my point is, if you're one of those people that you think all you have to do is just load up on stocks, that's what you should just put them in a 401k or an IRA and just continually buy, just like Jim Cramer tells me to do. And if the stock market goes down, that's great. I'm just going to buy the dip, and I'm just going to buy a broad S&P 500 fund. You have to understand that you are playing with fire right there. You have no edge. And in fact, you have a negative edge. And if you do make money over the short term, you have to understand you're lucky. You're just getting lucky. And for me, I would assume most of my fellow rebel capitalists, we prefer to rely on mathematics and having an edge as opposed to having to rely on luck for our financial future. All right, guys, and I'd like to point out that my good friend Chris Cole, who is the author of the Dragon Portfolio in this paper we just saw, The Allegory of the Hawk and Serpent, is going to be at Rebel Capitalist Live. He does very, very few speaking engagements, as you guys know, but I was able to get him to come down. So if you guys want to see Chris Cole live, got to get your tickets to Rebel Capitalist Live. And that's at rebelcapitalistlive.com. It's in Houston, January 7th through the 9th. Go there right now. Check out the speakers, get your ticket, and I look forward to seeing you in Houston in just a few weeks. Until that time, guys, make sure you stand up for freedom, liberty, free market capital.